Good morning, good afternoon, good night, everyone. My name is Arthur Hayes, and I am the CEO of BitMEX. This is our third lesson in our series about Bitcoin futures arbitrage trading. In lesson one, we discussed the basics of spot versus margin versus futures trading and some simple formulas to calculate a futures return and the difference between quantitative and inverse futures. In lesson two, we focused on cash and carry arbitrage and basic volatility arbitrage. And now in lesson three, we're going to get into some more advanced basis trading or curve trades. So now I'm going to share my screen and go to the slide deck. Okay, so in lesson three, what we're going to cover, first, I'll go over some simple formulas and definitions that I'll be using throughout this lesson. Then I will describe how to construct the futures basis term structure. Then we'll focus on curve roll down trades and curve directional trades. So first, some simple formulas. So when I refer to basis, what I'm talking about is the difference between the futures price and the spot price. The basis that I'll refer to will be in US dollars because both the future and spot are quoted in US dollars. T, or our time component, is just the difference between the expiry date and today over 365 days per year, also called actual over 365. Percentage basis per annum. Now this is probably the most important identity that we'll be talking about today. So this is the basis quoted in percentage terms on an annualized basis. R is our annualized interest rate, and we'll be using simple interest. So we will not be using continuous compounding interest. And as I've probably mentioned before, that is because when you actually deposit money at a bank, they only pay you once per day. Delta. So I'll refer to delta as a risk measure. And basically that is the Bitcoin value of the portfolio of futures contracts. And we'll value these futures contracts using the spot price because we want to isolate some other components of the price of the futures contract. So if you want to compute, say the market went up 10%, you would take the aggregate delta number and multiply it by how much the market went up or down to compute how much money you've lost or made based on the Bitcoin price movements. Now, the strategies that I'll be discussing today are what we call delta neutral, which means that there will not be an outright exposure to the Bitcoin price. Theta, or time value, is basically our basis. Remember, that's the difference between the futures price and the spot price divided by the number of days to expiry. And we can either quote basis in a US dollar or Bitcoin terms. I will quote it in a Bitcoin term based on the payout of the futures contract. Positive carry, which means every day you are making money, is when your theta is greater than zero. Is greater than zero. And negative carry is when your theta is less than zero. Okay, so let us go to the next section. Constructing the basis term structure. Now I will go to the first tab of the spreadsheet that has been provided. And we're looking here at the basis term structure. Now I've given three futures contracts, a weekly, a quarterly, and a bi-quarterly. So we have a weekly, a March, and a June futures contract. Here are the expiry dates listed below, and we compute our T, or time component. We're using a spot price of 100, and then I guess inputted some simple values. So when you're looking at a futures curve, you'll most likely, the first thing you'll think of is, let me plot the price of the futures contract for each contract and see what that curve looks like. And if you look here, we have a graph that shows the futures curve, and we see a nice upward sloping graph. And so we say, oh, that's great. This is what we call them contango, and maybe we should sell the back month and buy the front month. Now, to compare just outright prices with no concept of time, is not correct. We want to compare apples to apples, which means that a weekly futures contract that's at $110 when the spot is at 100 is completely different than a contract expiring in 6 months that's at $130 when the spot is at 100. So what we want to do, and what we have described in the past, is calculating that percentage premium per annum. And so here we've done this calculation. And so what you see is a different graph when you look at the futures term structure. You see that actually the weekly contract is the most expensive in terms of its premium or percentage basis per annum to spot, whereas the one expiring in 6 months is the cheapest. So if you just looked at the price of the futures contract, you would come up with a different conclusion about how to trade these markets. Now, it's very important for the types of trades that I'll be describing to always look at interest rates. We're not looking at the outright price of the futures contract because, as I said before, it's very hard to compare and make proper judgments. So once we've computed our basic term structure, it's time to get into our first type of trade, which is a curve roll down trade. So back to the spreadsheet. And what we have here is another some more prices for our weekly March and June futures contract. Spots at 100. And I've just inputted some futures prices. So what do we see here? Let's just change this to 2015. We have a nice upward sloping percentage basis per annum term structure. So what is the obvious strategy and they're using this term structure? Well, if we know we can make almost 500% on an annualized basis by selling the June contract, we want to buy something cheaper in terms of percentage basis per annum so that we can earn the difference. Because as I said before, we're not interested in taking outright positions on the price of Bitcoin, but only trading the differences in the curve. So let's assume that we buy the H16 and we sell the June futures contract, M16. So what have we calculated here? What we want to know is what is the interest rate between the June and March period. So we've calculated the time value between these two contracts. And now we've calculated the percentage basis per annum between those two periods, which is 600%. Now, what we want to look at is on an outright basis. So assume that we are selling the M16 and buying the H16. We have positive carry because we are selling something that is more expensive, receiving interest rates, and we're paying interest rates by buying the near dated or the H16. So when we look at futures contracts and interest rates, we want to think in terms of interest rates. So you always want to think whether you are paying or receiving fixed. Remember that when you buy a futures contract, you are locking in an interest rate for that time period. So if you are buying something that is more expensive on an interest rate term, so the spot price is below the futures price, and you're buying that, that means you are paying fixed. If you are selling, i.e. you're receiving the difference between the future and spot, you are receiving fixed. And if you think in these terms, it makes a lot more sense about what trades to do. So again, we want to pay fixed cheaper, i.e. 285% basis per annum, and receive fixed at a longer dated time span, or 500% per annum. And so now we come out with, we are making 150% outright, i.e. we take out the time component. So this is the time value times our basis per annum, and that is what we make for 64 days. Now this is very important. We just hold this strategy, why it's called a curve roll down. So we've gone long the H16 and short the M16. Now we wait. We wait for 64 days. In 64 days, the H16 is going to expire, and we will no longer have a long hedge to our short M16. Now, as I said many times, we are not taking risk on the Bitcoin price. So what do we need to do? We need to buy back our M16 contract. Now, assuming that we have the same term structure and we just let time expire, we will make this outright 150% outright return. However, we need to buy back another futures contract, i.e. we need to pay fixed again in 64 days. So we have a risk. If the interest rate on M16 rises to such a degree in 64 days, then we could actually lose more money than we made based on this than in the first 64 days. And so this is your P&L, your break even. So if the M16 future is trading at a 600% annualized basis in 64 days, you will have made nothing. So if it trades higher than this, you will lose money. If it trades lower, then you will make money. And so this is the determination you need to make. If after the shorter dated leg of my trade expires, do I think that the interest rates for the M16 will rise to such a level? And you need to make that call. And that's why this is not a truly risk-free strategy, but there is an element of risk to this. Now, this is the easiest version where you're selling the longer dated and buying the, the shorter dated. Now, let's reverse this. Assume that the weekly is trading quite expensive. So now we are selling the weekly contract and buying the monthly. And as you see here, you're actually going to lose money on an outright basis on this trade. So even though these percentage basis terms are in your favor, this has greater time value. Remember the R times T, which will affect this trade. So usually the proper way or the easiest way to do these trades is to sell the longer dated and buy the shorter dated, because as I said, you benefit in a greater way from the increased time value of the longer dated contract. So this is the curve roll down strategy. And now let's transition into curve directional trades. So if we go to the next slide here. So now we have a portfolio of some futures contracts. And we have a H16 and M16 futures contracts. Now let's say, and this is the term structure. So the H16 is trading at $150 and the M16 is trading at $300. And now we look at our entry basis per annum. Now, in the previous example, we described a situation where we sold the expensive futures contract on a percentage basis per annum terms, and we bought the cheaper futures contract. Now we're going to put on a directional play. We don't aim to hold these contracts until one of them expires, but we are making a determination on whether or not the curve will steepen or flatten in the interim time period. So let's assume we put on this trade, long M16, short H16. Now let's go down here. How do we make money on this trade? We're long the M16. So what we want to do is we want the spread to widen. So that means either, let's assume that we keep M16 flat, either H16 declines in terms of annual basis changes, right? So the spread has gotten wider. And you can see our profit and loss here. We've decreased the basis of H16 by 20%, and we assume that the spot hasn't changed. It doesn't really matter. We've made 3.51 Bitcoin on our H16, and the M16 is flat. What about if M16 goes up? So as we increase this, i.e. the spread continues to widen. Now, this situation is also where the spread widened. It went up 10%, but we lost money. Why is that? That's because we have to remember the time value component of this trade. So let's look down here just at the basic two risk measures that I talked about. We have our delta component, which is the Bitcoin risk at a spot basis, so 100 minus 100 versus a long 100. We have our basis risk. So this is just a representation in Bitcoin terms based on our multiplier of what is the differential between futures and spot price. And then using this basis, we compute our theta. So if we are short something that is at a premium, we are receiving carry, i.e. we have a positive theta. So we multiply this by -1. If we are long something, i.e. paying fixed, we have a negative theta. Every day we lose money because that is the interest rate that we're paying for this leverage and for this position. Now, this is a situation. We've put on a curve steepener, i.e. we want the differential to increase. However, the differential increased by 10%, but we've lost money. Why is that? That's because we have such a greater negative theta value on our longer dated position because of the time value component that it negated the steepening effect of the curve. And this is something that you should keep in mind whenever you put a trade like this on. You should stress your portfolio in either direction to make sure you understand exactly how it will perform under certain circumstances. Now this is a steepener. Let's put on the opposites trade, a flattener. So the differential is going to narrow, and we'll change the direction of the trade around. This is a flattener, and again, the massive negative theta on M16 is working against us. So when you are in a situation where you have a curve where the shorter dated contract, you're selling the longer dated contract. Sorry, you're selling the shorter dated contract and going long the longer dated contract, and hoping for the term structure to flatten, i.e. this one to move up. You need a large movement just to happen for this effect to really affect your portfolio. So let's put on the trade that we had previously. Again, as we see, the curve flattens. We sold something expensive, and we think that the short date will come up in terms of percentage basis. And as this differential narrows, we are flattening the curve and making P&L. again, and also the other direction can happen, whereas the longer dated can come down as well. So to summarize this, in both of these types of trades, we are constructing delta neutral portfolios, i.e. there is no risk in terms of the spot price of Bitcoin. And what we want to do is capture interest rate differentials, whether that's the curve steepening or flattening. Now, in terms of probably the easiest way to get started using these trades is to do a curve roll down strategy, i.e. looking at the current term structure of BitMEX futures contracts, where you have the longer dated trading at much higher prices than the shorter dated contracts. You want to be selling, so for this example, say XBT M16 and buying XBT H16, because XBT M16 is trading on more expensive on a percentage basis per annum term. Now, this strategy is much easier because all you have to do is put on the short M16 versus long H16 and wait. And then hopefully after the 2 or so months, you can then buy back your M16 at a cheaper price because of the positive carry that you've received. That time value is decreasing every day. So the futures contract will become cheaper in 64 days. Doing the curve directional trades takes a little bit more monitoring, because you need to think about what is your theta loss going, and how is that going to affect the trade. Either you have a positive carry or negative carry. Having a negative carry doesn't necessarily mean that your trade will lose money. However, you just need to have that much higher or that much more effect in the direction that you think the market's going to go for you to actually make money. And so in the next lesson, in lesson 4, our final lesson for this series, we're going to talk about how to construct risk management measures. So we're going to talk about delta, theta, and what I've called the Bitcoin value of 1 basis point, and how the 3 of these metrics combine will help you construct proper curve directional trades and monitor the risks that you're taking, especially if you have a portfolio of futures contracts with a lot of different maturities. Now let's see if we have any questions. I think it might be on the other. Okay, no questions from the crowd. I understand that this might be a little bit more complicated than our previous lessons, but don't despair. I've also written a full series of blog posts that describe basis trading in even more detail and provide some more examples that you can see on the BitMEX blog. So I hope that everyone will tune in next week, where I go over probably the most important part of trading, which is risk management. Because you can have trades that make money at one point and lose much more at another, and all of that is due to how you manage your risk and how you view your risk, and the types of risk management variables that you are observing. So thank you everyone for tuning in, and keep calm and trade crypto.